In 2015, a modern European nation came within days of financial collapse. Banks shut their doors. Cash withdrawals were rationed. Pensions were frozen. And the country that had given the world democracy, philosophy, and currency itself was negotiating its survival with international lenders. This wasn't ancient history. This was Greece, a country inside the Eurozone, a member of the European Union, operating with one of the world's most stable currencies. And yet it was on the verge of default, like an empire in its final days. How did this happen? How does a developed nation, backed by global institutions, bound to a currency shared with Germany and France, end up begging for bailout after bailout? And why does this matter to you, even if you've never set foot in Athens? Because what happened in Greece wasn't just a local crisis. It was a modern case study in how the global financial system works, how debt becomes a political weapon, and how quickly sovereignty can dissolve when money runs out. Let's rewind. The seeds of the crisis were planted long before the headlines. Greece joined the euro in 2001, giving it access to cheap borrowing it had never experienced before. For decades, Greece had been a high-debt, high-deficit country. But with the euro, markets assumed the risk was shared. Investors believed that Greek bonds were as safe as German ones. Suddenly, Greece could borrow at historically low interest rates. And borrow it did. Public spending rose. Infrastructure projects boomed. Salaries in the public sector increased. But while some of the money went into roads, airports, and modernization, much of it fed a bloated bureaucracy and an inefficient tax system. Corruption and tax evasion were endemic. The government's revenues couldn't keep pace with its expenses. And underneath the optimism of the 2000s, the debt kept piling up. By 2008, when the global financial crisis hit, Greece was already running one of the largest deficits in the Eurozone. The collapse of Lehman Brothers sent shockwaves through global markets. Investors began scrutinizing government debt more carefully. And when they looked at Greece, the numbers didn't add up. In late 2009, it was revealed that Greece had been underreporting its deficit for years. The real figure was closer to 15% of GDP, far higher than allowed under EU rules. Confidence evaporated. Borrowing costs skyrocketed. Greece was shut out of the bond markets. And in 2010, it had no choice but to seek a bailout from the European Union and the International Monetary Fund. But bailouts don't come for free. The first rescue package, worth €110 billion, came with strict conditions: massive spending cuts, tax hikes, pension reforms, and labor market liberalization. These austerity measures were designed to reduce the deficit and restore investor confidence. In reality, they plunged Greece deeper into recession. GDP contracted. Unemployment soared, hitting over 27% by 2013. Youth unemployment surpassed 60%. Public services were gutted. And the debt, the very thing the bailouts were supposed to solve, kept growing. Because here's the math no one likes to admit. When an economy shrinks, the debt-to-GDP ratio gets worse, even if you're repaying loans. By 2012, Greece required a second bailout. This time, €130 billion, along with a historic haircut for private bondholders, a partial default in all but name. But the debt burden remained unbearable. The crisis dragged on for years. Each bailout came with more austerity, more conditions, and less growth. In 2015, under the left-wing Syriza government, Greece held a referendum rejecting the bailout terms offered by creditors. The no vote won decisively. But days later, the government agreed to an even harsher deal. Why? Because the alternative, leaving the euro, returning to the drachma, and declaring full default, would have been catastrophic in the short term. Greece's sovereignty, at least in economic terms, was gone. Key decisions about its budget, taxes, and spending were now dictated by the Troika, the European Commission, the European Central Bank, and the IMF. What happened to Greece wasn't unique. The mechanics were ancient. Debt has always been a tool of power, a weapon in diplomacy, a means of control without armies. In the 19th century, the Ottoman Empire entered into similar arrangements. After repeated defaults, European creditors effectively took control of its customs revenues through the Ottoman Public Debt Administration, directing money toward repayment instead of sovereignty. The same happened to Egypt in the 1870s. After taking on massive loans to modernize the country, building railways, expanding the Suez Canal, Egypt defaulted. Britain and France stepped in, not just as creditors, but as managers. Control of finances became control of the state. In both cases, the empire still existed on paper. Flags flew, leaders spoke, but the real power lay with the creditors. And that's exactly what Greece experienced in the 2010s. Not an occupation by soldiers, but a financial trusteeship. The Troika became the shadow government, deciding what could be spent, what could be cut, and how fast debts would be repaid. For ordinary Greeks, the crisis was brutal. Pensions were slashed. Hospitals ran out of supplies. Thousands of small businesses closed. The social fabric frayed. Yet through it all, the debt remained high. Even today, Greece carries a debt-to-GDP ratio of over 160%. The economy has stabilized, but at a lower baseline. The cost of survival was a decade of lost growth. So why does this matter now? Because the same forces that crushed Greece are still at work. Look at emerging markets today. Countries like Sri Lanka, Pakistan, and Argentina are wrestling with debt burdens, IMF programs, and the trade-offs between austerity and sovereignty. The names are different, but the structure is the same. Heavy borrowing in good times, crisis when markets turn, and dependency on external creditors when money runs out. Look at advanced economies. Italy carries one of the highest debt loads in the Eurozone. Japan's public debt is over 250% of GDP. Even the United States, with the privilege of issuing the world's reserve currency, has seen its debt climb past $34 trillion. The difference is that large economies can delay the reckoning, but delay isn't immunity. And this is where the lesson sharpens. Greece's crisis wasn't about numbers on a spreadsheet. It was about the loss of flexibility. When you can't print your own currency, when you can't devalue, when you rely on external financing to function, you're not in control anymore. Your policy space shrinks. Your choices aren't yours. That's the danger for any nation. Debt is easy when times are good. It's invisible, painless, almost free. But the moment markets lose confidence, the cost spikes. And the people who lent you the money aren't just creditors anymore. They become decision makers. For individuals, the lesson is the same. Debt reduces freedom. It narrows choices. It ties you to the terms of someone else's system. Whether it's a family budget or a national one, the more dependent you are on borrowed money, the less control you have when conditions change. The fall of Greece wasn't a collapse in the ancient sense. No armies, no conquest, no walls breached. It was a surrender in practical terms. And it happened inside one of the most advanced economies in the world, under the watch of global institutions designed to prevent exactly this kind of crisis. History doesn't repeat, but it rhymes. And when you see a modern country default like an empire, you realize how fragile financial freedom really is. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.